finances, wealth, wisdom, stewardship, legacy, God's design. Get ready to learn about the gospel of finance. Let's get started.
Had a conversation the other day with a friend of mine, and in that conversation, it ended up being very disturbing. And the reason why it was disturbing was because he didn't know what he was talking about. Very educated individual and very knowledgeable about subject matter that pertains to him. But like with all people, when you step outside your lane and you start treading into waters that you have no experience in, but thinking that you're the top dog or you're the guru of this particular area, having no experience in that area, that now becomes disturbing. And that was the situation with my friend, because we were talking about retirement. We were talking specifically about 401ks. And 401ks have their place. Now, when it comes to the issue of retirement, is it my suggestion that people starting off in life get a 401k? Absolutely not. For those individuals that have 401ks, do you stop doing it and you move to something else? Maybe. If you're closer to retirement, the best result is probably to see how we can convert that into something that is more tax friendly. But oftentimes, once you get in these 401ks, it's a done deal. It's a wrap. The time that you put in, the money that you make over a period of time, it will accrue, it will grow, you'll make money in it. But at the same time, there are certain things that come with the 401k. It is a double-edged sword. These things that come with the 401k, you have to know, because if not, then it will end up costing you a lot of money. Now, traditionally, 401ks go back to right about the early 80s, roundabout. The 401k took over the retirement from pensions. Pensions ruled the roost before 401ks came into existence. Now, there's several things about 401ks that you need to understand if you're going to be successful in using 401ks, and successfulness is really based on you learning how to navigate the tax portion of your 401k. Now, certain parameters surround the 401k, how much money you can put into it, when can you draw the money, how long you can keep the money in the 401k before the IRS makes you draw the money. All these things play a part in the design of the 401k. But let's go back to the beginning. The 401k by design was never designed for the employee. It was always set up and established for the employer. 30-foot overview, you had a CPA or some top accounting people that scoured the IRS websites to find out how to get their employer better rates and how to defer money into different periods, thereby lowering taxes. Now, in putting together this scenario for the employer, what the accountants and the CPAs and all of these individuals came up with, they came across a IRS tax code that would allow them to do that. And they would actually receive an extra benefit if they got the employees involved, because they could put more money into or defer more money to different periods if they gave some money towards the employees. That IRS code was IRS code 401k. Now, this is simply a 30-foot overview, not a lot of the detail going into the 401k, but basically that's telling you how it got set up. So it was set up, number one, for the employer, not the employee. The downside or the flip side of the penny for 401ks is that when you start looking at the taxes, one thing that's never taken into account is that if I have $1 right now and you tell me I've got to pay tax on that dollar, let's just use 10%. Then I'll give you 10%, keep 90 cents. If you told me to hold that dollar and wait 30 years, and as that dollar grew, I'd have to pay 10% on the growth, then that's a game changer for me. I'm stopping the card. I'm saying, no, wait a minute. I'd rather give you 10 cents now than wait 30 years and pay you the taxes on the gain of what I'm making versus paying you that little bit of money right now. I'd rather pay tax on the seed versus paying tax on the harvest. Now, what the 401k does, it forces you to pay tax on the harvest. And when you start doing this from an accounting standpoint in tax, and I've been doing taxes now for about a little over 30 years. And so in understanding the taxation part of 401ks in the whole retirement scheme. What you got to keep in mind is that you can lose literally up to 40% of the value of your 401k before you draw that first dollar. Uncle Sam's going to get his money regardless. It would be much better for you to pay taxes on that dime, on that dollar, than pay tax on the gain over a 30-year period. Now, there are ways for this to happen. There are ways for you that you can do this. And I've got a perfect example because in that same discussion I had with my friend, I have a client right now that will, when he gets to retirement age, he'll be drawing about $10,000 a month from his retirement, all of it tax-free. We were effective in getting his tax margin, his tax rate down to zero, so that when he moves into retirement, he'll pull out 0%. He'll pay no taxes on the money that he put in. But in addition to that, the Social Security that he pays into, he'll get that money back. And hopefully, if the tax laws hold true and the government does what they need to do, he'll pay very little or no taxes on the Social Security. And that's where you want to be. So when people are looking at retirement, the biggest challenge is this. You have to take a look at the quality of life that you're going to be living when you get to retirement age. How does the quality of life, how is that defined? That's defined by the amount of taxes that you pay. Certain things we're going to know. Number one, we will know that the value of the dollar will probably decrease over a period of time. So in the next 10, 15, 20 years, the value of that dollar, it probably will go down. The second thing we know is that if, depending on who's in office, but several things. One, the cost of living is going up even now, and the cost of living will probably go up even more by the time you get to retirement. So the value of the dollar is going to go down. So you're talking about increased taxes, increased cost of living, the value of the dollar going down. So the power or the value of your money and how you situate your money will mean everything. Now, most of your retirement planners don't even take that into account because their job is to get as much money into the account so they can get bigger fees. Now, how do I lose money in the 401k? Well, taxes, depending on the tax bracket. So if you're in a 20% tax bracket, statistically, most people, when they retire, they don't drop down to lower tax brackets unless it's a planned event. So that's something you got to keep in mind. So taxes up to about 20, depending on your tax bracket, up to 36%. And so on top of that, you're going to have management fees because the same company that's managing their 401k, if they're managing it at all, they're going to charge up to 4%. And then from there, you got to keep in mind that there may be what's called a market correction, a market crash. And I've had that happen with several clients, and they've had their money in the stock market in different investments, and their money in those investments took a downturn. And we don't want that downturn to happen right when you're about to retire. Makes a big difference. So if I'm a year out, 2 years out of retirement, and the market corrects, and I lose 30% of my portfolio, and then on top of that, I got to pay taxes, and you still got to pay the management fees. Man, what did you go to work for over the last 30 years? And that's what people have to keep in mind. The average balance in a 401k is roughly right about $105,000. $105,000. Now, if you take the average median income in America, which is right around $55,000 as the last checked, numbers could change, very fluid. It does fluctuate, but somewhere between $50,000 and $55,000. If you got $100,000 in after you've worked 30 years, keep this in mind. You've worked 30 years. You've got $105,000 in your 401k. You make $55,000 a year, or just $50,000 for good math. So you make $50,000 a year. You got a little over $100,000. Now, before taxes, you've only saved enough to be in retirement for 2 years. So what are we going to do now? That doesn't even take into account the fact that you still got to pay tax on that money. And the market still might correct unless you ship that money into something that's a little safer. And the management fees, they get their money whether you make money or whether you lose money. They're going to get paid regardless. And so that's a very bad situation. And most people that work these hard jobs, they work these labor jobs, and even management jobs that have put money into these 401ks thinking that it's going to amount to something, end up getting surprised because the amount of time that is built up for you to be in retirement based on the 401ks, it doesn't equal up to the time that you put into it. I worked 30 years. I thought I could be in retirement for at least 25 to 30. But in all actuality, for most individuals across the nation, you're talking about being in retirement maybe 2.5 years. Then you're forced to go back to work. Or there's going to be a very, very, very drastic lifestyle change. And those things are considerations that most people don't even think about. So is a 401k the best thing? In my opinion, humble opinion, it is probably the worst retirement vehicle that you can put your money into. You also have to ask yourself this question. For those bosses, those business owners, the ones that own the companies that you work for, how do they structure their retirement? Because I can promise you this, 9 times out of 10, they're not using a 401k. So what are they using? Well, it goes back to several different things, but this is one area that you have to keep in mind. You have to start looking at what they call personal pensions. Because in retirement, two things are very critical. One, cash flow. So when I get to retirement age, for the time I say stop, pull the plug, I slide into home base and I'm saying I'm not doing anymore. When you hit that mark, it's all about cash flow from then on out. Until the day that you go home to be with the Lord, from then until then, it's all about cash flow. Second thing, you have to consider your tax position. And this is an area that I just get so frustrated, because when you start talking to these people that call themselves retirement experts, they don't even think about this. It's not even a clue in their mind. What do you mean you didn't calculate the taxes? You didn't look at the taxation? So when they get into retirement, that's not a consideration. Now, that's something that I do, and something that the company and the people I work with, that's what we do. But by and large, if you never come and see me and you've got somebody who calls themselves your financial advisor, if your financial advisor is not advising you on the taxation of your finances when you get into retirement and how to minimize the tax in order to maximize the amount of money that you get from your retirement, they're doing you a disservice. You might as well just take the money, take it out, and just start lighting it up, just start burning it, because it's wasted already. Because I can bet you this, I can bet you that they're going to get their fees. I bet they know those down to the penny. They know exactly how much they're going to get. But when it comes down to your money, the money that you worked for hard over the last 30 years, if they can't answer those questions, I promise you, you are with the wrong person. Because at a basic, like I said, when you get into retirement, you cross over that threshold. It's not about the amount of money you have in your 401k. The most important part of the retirement portfolio is taxation and cash flow. Those are the two most important parts of your portfolio. Not how much money you got in there. Because if you got $1 million in there, but you got to pay 40% of that in taxes, and then everything else kicks in, you're going back to work. You will go back to work, whether you want to or not, because the quality of your life is going to drastically be impacted by the decisions that you fail to make. So when my friend was talking to me about this, he was just adamant about the fact that he knew more about this particular product that we were talking about than I do. Now, I've been working with this particular product. I've been doing personal pensions, taxation, retirement planning, all this stuff over 30 years. But he was adamant about the fact that with this particular strategy, let's call it that I use, that he is totally against. But the crazy part is, you don't even know it. You can't even use it. As a matter of fact, he would lose his license. He would lose his contracts if he even tried to sell this product. He knows absolutely nothing about it, has no training in it. Everything is third and fourth hand information. But now you're the guru on this particular area. And I told him, I said, respectfully, I said, the reason why you're so adamantly against it is because you can't sell it, because you get no commission on it, because if you even tried to sell it, the company that you work for would probably fire you, because that's not in their arsenal. That's not in their portfolio of products to sell for retirement. And so, in thinking about it, and I would say this particular person, because he might be watching he's a good person. I like him. I love having conversation with him. But in this particular instance, he's just wrong. He's just wrong. And to come at someone like myself over 30 years that have done taxes and done tax planning and retirement planning for clients. If you've never done it, then there's absolutely no way we can have a conversation, because everything I'm talking about is completely over your head. Because there's tax revenue, there's tax laws, IRS codes that I know of that are specific to what we do, that if you're not in this industry, you have no clue. And you'll trip over your feet trying to get it done. You won't, it'll be a hot mess by the time you get finished. And then you'll be calling me to fix up what you just messed up. And that's where most people are. So the issue is not with this individual. It's not even with his mindset. It's with the mindset of a lot of individuals that fall into the same category. Because of what you don't know, be careful to make sure you know that if you don't know it, seek out those that not only know the information, but have worked in the industry, hands-on. Much like if you go to the hospital and you have to have a surgery, I don't want somebody who call themselves a doctor but never had performed any surgeries. You don't need to be working on me. I'm sorry, you need to practice on somebody else. I need somebody that has experience, somebody I can talk to, somebody that has in-depth knowledge, somebody that has actually cut somebody open and looked on the inside and then got finished, sewed them back up right without any type of lawsuits. That's who I'm looking for. And you need to be looking for the same type of person when it comes to finance. And those that have worked in taxation, tax planning, those that are familiar with tax codes and tax law, these are the individuals that you seek out. But with the 401k, it is probably, again, the worst platform that you can use when it comes to retirement. But if you're using it, there are strategies and ways for you to minimize your taxes so that when you retire, you're not getting hit as hard. But you got to go to the right people. You got to find individuals, again, that are versed in taxation, tax law, tax accounting, tax planning, not just retirement planning. Let me say that again. Retirement planning and tax planning are two different things. The two can and they do go together. And if they go together properly, you win. You win because they will minimize your taxes, maximize your cash flow so that your retirement is a lot sweeter. But if you find the wrong individuals and they just want to maximize and put your money out there, you're making a whole bunch of money, but they have no plan for when you retire, then you're going to be in a bad way. There's a story about Mount Everest and those that climb the mountain. And it is said that most of the people that died climbing Mount Everest did not die on the ascent. They didn't die climbing the mountain. They died when they were coming down the mountain. And this is something to keep in mind, because when it comes down to retirement, most of the people that we engage with, the people that unfortunately we have to work with, are those that are in the process of dying, because on the way down, you built all this money up, going up the mountain as far as your retirement is concerned. But when you start coming down, when you get to the place where you're retiring and you start to pull this money out, and but you've done no tax planning, you've done no planning, period. You just want to take the money out. And all you know is a whole bunch of taxes. That now becomes a challenge. So keep those things in mind, and we will sort of round this out the next go around in one of the next sessions so that you can have a good idea of what your position should be like. We'll talk with you on the next go around.